What's up everybody, Gen X Dividend Investor here. I wasn't planning on releasing a video this week because I'm heading out on vacation for a few days, but I noticed I was getting multiple new all-time dividend payout records for 2 of my 3 SIN stocks, so I thought this would be a fun one to quickly do. So in this episode, I'll share my entire portfolio and all its divvies, and highlight my new SIN stock payouts. I'll also share my perspective on the ethical and moral implications of investing in tobacco stocks. I'll start with going over my tobacco tickers and their income, then I'll show you my portfolio in Fidelity and then my spreadsheet tool. Feel free to use the timestamps if you want to jump ahead, but I recommend not skipping. And I want to open this by saying that I don't recommend anyone invest in Altria or British American Tobacco or Philip Morris just because I do. I think everyone needs to invest in a way that makes sense to them, and I'll never push a stock I own on anyone else. Every investment has risks, and part of the reason SIN stocks often have higher yields is because they carry a good amount of risk. Okay, so the first new all-time payout record I'm talking about is for Altria, ticker MO, which pays on Friday, October 10th, which is probably yesterday for many of you watching this. I'll be getting an MO dividend of $4,027, which is my largest normal quarterly payout I've ever gotten. I say normal because I have gotten dividend distributions from spin-offs and such, which were larger than 4K, but all those were one-time things. This new 4K MO divvy takes my annual Altria dividends to be a little over 16K. And note, my SIN stocks represent about 19% of my overall dividend income. You can also see that tech tickers are almost 22% of my income, consumer staples are about 10%, energy is about 10%, etc. Now let's take a look at my Altria income over time. This is part of my spreadsheet that I call my dividends received tracker, and it automatically puts this info into my spreadsheet as time goes on. And I'm just showing part of my tickers in this section. People sometimes ask me if they can get a copy of my dividend spreadsheet, and the answer is it's something I sell as a service to my Patreon Aristocrat and Kings because it connects up to multiple backend databases, including stock data I pay for. Okay, and I'm actually recording this a few days before my Altria payout, which is why it's showing that I've gotten $0 of $4,027 I'll be getting this month. Going back in history with Altria, we see that I got a payout of $3,875 in July, and that amount is lower than my most recent payout because Altria did a dividend hike. It wasn't because I bought any new shares. Then going back further, we see in April I again got $3,875, and I also got that back in January. Once again in October of 2024 I got $3,800 from them, and then in July of 2024 I got $3,723, so a smaller dividend hike in that year. I stayed at quarterly payouts of $3,723 until I get to October of 2023 when I got $3,629. Then as we go back in time, we see $34.81 for a few payouts, and then $29.29 for a few, then $25.46, $24.32, etc. Altria was averaging 10% dividend hikes, but then started doing smaller ones more recently. Plus, Altria has been buying back its shares over time, which means I've continually owned a greater percentage of the company, even though I'm not buying any more shares. Like back in 2011, there were 2,084,000,000 Altria shares outstanding. I currently own 3,799 shares of it, worth about $250,000, and it used to be a smaller position in my portfolio, but it has materially outperformed the SP 500 over the last 5 years, on average, so my position grew a lot faster than I expected. Anyway, over time Altria has kept buying back its shares, as this downward chart shows. So like in 2011, it was at 2.084 billion shares outstanding. Then by 2013, they bought them down to 1.9 something billion shares. Then by 2018, it was down to 1.8 something billion, then 1.7 something in 2022, and now in 2025 it's down to 1.6 something billion shares. That means if you owned Altria back in 2011, you'd now own 20% more of the company without buying any more shares or doing anything. And if you had been reinvesting your divvies, then your ownership percentage would have increased a bunch more. Some people don't like buybacks, but I do, as there are multiple benefits to them. Yes, I like divvies more, but I still appreciate buybacks. I mean, like I said, buybacks mean each shareholder owns a greater percentage of the company. They also make the earnings per share get pushed up because there are less shares out there. And since stock prices tend to follow earnings, that means stock prices also often get pushed up, which is again good for shareholders. Plus, having less shares means it's easier for them to support paying out dividends. Less shares often pushes their payout ratio to a smaller percentage, meaning their divvy should be more sustainable. Now, one interesting thing to be aware of is that tobacco stocks are known for running hot, as their payout ratios are often in the 80% range. For most companies, I'd be concerned if I saw a ratio that high, because it could suggest a fragile dividend that isn't covered by enough cash flow, or it might imply lack of reinvestment. But I'm okay with an 80% payout ratio for this type of tobacco SIN stock, because they tend to have stable, predictable, and resilient cash flows because the demand for their products are relatively inelastic, i.e. the people who smoke tend to keep smoking regardless of what's happening in the economy. Companies like MO also tend to have low capex needs because they aren't constantly building new factories or investing heavily in R&D compared to, say, a tech or industrial company. Those factors allow management to confidently distribute a larger portion of earnings to shareholders without jeopardizing the long-term health or operational needs of the company, which is why their payout ratio is higher than normal. So it kind of makes the high payout ratio a feature of their business model, not necessarily a bug. But to state the obvious, tobacco sin stocks have lots of risks, and I'll name the big three. The first is regulatory and political risk, which I feel is the most significant threat. It includes government actions like high and escalating excise taxes, complete or partial product bans like we've seen with menthol or flavored vapes, and mandates for product changes like very low nicotine levels, all of which directly erode sales and profit margins. The second is structural decline risk. What I mean is that the core business of combustible cigarettes is in secular decline, broadly speaking, as health awareness rises. And while many sin companies are pivoting to what they call reduced risk products like e-cigarettes and heated tobacco, it's still uncertain to me if the growth of these new categories will be fast enough or profitable enough to offset the persistent decline in traditional cigarette volumes, though so far it has been. And finally, there's legal and ESG risk. The industry faces perpetual litigation, often resulting in massive settlements and legal fees. Plus, the tobacco sector is increasingly excluded from major environmental, social, and governance funds and mandates, limiting the pool of potential institutional investors and potentially depressing stock valuations. Like Norway's sovereign wealth fund is one of the largest in the world, on the order of $2 trillion. They exclude investing in tobacco producers. Okay, let's get back to my divvies. Another new quarterly payout record I just got was from British American Tobacco. This is an ADR I own because it's an international stock, though because of our tax treaty with England, we don't deal with international tax issues. Actually, it's not really our treaty, it's because the UK generally does not impose a withholding tax on dividends paid by UK companies to foreign shareholders. And at the moment I'm doing this part of the video, I'm scheduled to get a payout of $2,282 next month from BTI, which means I get about $9,000 a year from them. I said as of this moment because my spreadsheet dynamically updates the payout amount based on changing currency conditions between the British pound and the US dollar. Going back, we see that in August they paid me $2,220, then $2,233 in May, and the slight delta in payouts is due to currency fluctuations. Then I got $2,032 in February, $2,122 in November, $20.97 in August, and it slowly trends down going back because they also have been doing small dividend hikes over time. And note, I'm not reinvesting most of my dividend tickers anymore because I'm retired and have been living on dividend income for over 5 years now, so when you see changes in payouts, that usually means it came from dividend hikes or cuts and currency changes, or changes in dividend income ETF composition. Okay, then the third sin stock I own is Philip Morris, and across all three I make a total of $29,000 a year of sin stock dividend income, which is 19% of my portfolio's income, as I make about $151,000 of dividend distributions a year. Now let's jump into my Fidelity account, and I took this screenshot on Sunday, October 5th. You can see that I have 3 investment accounts worth $3.5 million US, with $1.54 million in my IRA, $1.75 million in my taxable, and $233K in my wife's retirement account. One thing I want to say is that I completely understand that seeing someone else's decently sized dividend portfolio can spark a mix of emotions from motivation to frustration or even a bit of envy. But please know that when I share this stuff, my intent is never to annoy or brag. My primary goal is just to tell you how I did it and to illustrate what consistent commitment and compounding can achieve over multiple decades of investing. And so I've created several video playlists to help you get started. You'll find one that covers my background, career, and how I made my money over time, another that walks new dividend investors through how to begin, and one that explores the risks, concerns, and criticisms of dividend investing, including why some people dismiss it and what you should really know. Together, my hope is that my playlist gives you a foundation to create your own investing roadmap. I started from a negative net worth and built everything I have from scratch over more than 30 years of investing, with zero inheritance, zero lottery winnings, and zero employment at any hot tech firms like Amazon, Google, or anywhere like that. My point is that if I did it, then you can too, though don't compare where you are in life with where I am. I just want everyone to have the chance to experience a stronger financial future that can come from investing in good assets over multiple decades. I want you to see for yourself that you can build a life where your passive investment income truly helps your retirement. Anyway, in this Fidelity screenshot, you can see that I'm 93% domestic US stocks. I'm not of retirement age, so I'm paying the 10% tax penalty to withdraw my divvies early from the retirement accounts. But I'm not doing a 72T yet, as I hope to do some sort of Roth conversion if I come into some cash down the road. Like the house we're living in has appreciated a ton, so maybe if we sell and move overseas, then I'd use the cash to do a Roth conversion. Okay, I'm quickly going to show you each of my brokerage accounts for anyone who wants to take a screenshot or doesn't believe it's real, but I won't go over each position since I'd rather show you the overall numbers in my spreadsheet tool. So here is my IRA. You can see that I have $1.54 million worth of tickers, which Fidelity estimates generates about 68 grand in divvies per year. Moving on up next is my taxable account. Here you can see that it has 1.756 million in it, and it yields 74,000 and change of dividends per year. And finally, the rollover account. It has about 234k of tickers in it, and it yields a little over 8 grand a year. So in total, Fidelity estimates that I make $150,403 a year in passive income. Now, before I show you the combined view of my tickers in my spreadsheet tool, I want to talk about reasons why you might not want to invest in tobacco stocks, as well as some reasons why I do, beyond the risks I already shared. I mean, tobacco stocks obviously come with a lot of baggage, and the main risks are already well known. What has really changed is how those risks now feed into one another. Like, regulation is no longer just about raising taxes or limiting advertisements. Now some governments are openly talking about ending smoking altogether. To me, that turns the traditional cigarette business into something that feels less like a slow decline and more like a countdown. Will that happen? I don't know, but you should be aware. Beyond that, I should say that the ESG issue has become more than just a reputation problem. It's now a structural part of how the market treats the sector. I mean, more and more funds and institutions are against owning tobacco stocks, so the investor base keeps shrinking. That can push valuations lower and makes capital more expensive, which makes it even harder for companies to reinvent themselves. Plus, the stigma has become part of the financial equation. Ethically, tobacco stands apart from other controversial industries because the harm is built into the product. There is no safe or responsible use of it, which is why people are skeptical about the industry's move toward reduced risk products. And even if those alternatives prove to be less harmful, a lot of investors and consumers simply don't trust the same companies that created the problem in the first place. All that being said, I still have reasons why I choose to invest. I mean, the cash flow these companies produce is hard for me to ignore. And the demand is remarkably stable because of how addictive the product is. And that stability translates into steady profits and some of the highest dividend yields in the market. So I see a lot of financial resilience in their business model, at least for as long as the regulations don't kill it. There's also a contrarian appeal. I mean, because so many investors avoid tobacco for ethical reasons, the stocks often trade below what their cash generation would justify. That leads me to feel that there can be value left on the table for those willing to hold something unpopular. I also think the transition to newer nicotine products, while uncertain, could still have real upside. If even part of that shift works, the market may be underestimating how long these companies can keep throwing off cash. And to be honest, there's also a personal layer for me. I mean, my mother-in-law, who I've mentioned in past videos, has been a smoker for more than 60 years. My dad smoked for a while as well, as did several other relatives. I've watched the health consequences up close and thought about the enormous amount of money that went into buying those cigarettes over the decades. So in a strange way, part of my investment in these companies is about taking some of that money back. I know it doesn't change the harm that was done, but there is something satisfying about reclaiming some of what they spent supporting an industry that took so much from them. So yes, the risks are serious and the ethics are complicated, but I can rationalize an investment case that makes sense to me. I see powerful cash machines operating in a shrinking but highly profitable niche. At the same time, I completely understand anyone who refuses to invest in tobacco for moral or whatever reasons. If you see it as supporting a cancer-causing, death-dealing industry that profits from addiction, that is a completely fair and valid stance. There is no way to separate the profits from the pain, and if someone wants nothing to do with that, I respect it. For me, it's not about endorsing tobacco or ignoring its damage. It's about recognizing both realities at once, the moral cost and the financial truth. But I also believe there's a future for these companies beyond cigarettes. Like if cannabis ever becomes federally legal, which I think it will, then the established tobacco giants will be in the best position to dominate that market. They already have the distribution networks, regulatory experience, and scale to move fast once and if the laws change. Add in the ongoing innovation in reduced risk and nicotine alternative products, and I can see a realistic financial path forward. It's risky, no doubt, but I see potential for reinvention rather than total decline. So bottom line, that's why I invest in them, but I also don't think anyone else should. Okay, with that being said, now let's jump into seeing some of my dividend portfolio details in my spreadsheet tool. Here is page 1 of 2 of my tickers, sorted from largest position to smallest. So Altria is up top, and it's 7.07% of my portfolio right now, and you can see how its dividend pay date is on 10/10 for $4,027. In total, I get $16,108 from Altria a year, and it's currently at a 6.45% dividend yield, along with a small 3.96% dividend CAGR, as its hikes have slowed down in the last few years. Next is Realty Income, which is about 6.5% of my portfolio, and I have about 229 grand of it, and it yields $1,022 a month, or a little over 12 grand a year. Then is a dividend ETF and SCHD, and I have 8,078 shares of it, worth 221 grand, and it generates $2,088 a quarter, or $83.50 a year. I currently reinvest 20% of each of my dividend ETFs back into themselves, though everything else I'm taking out is cash and using it to pay my family's bills. For example, this weekend I'm heading out of state on vacation, and all that's being funded by my divvies. Okay, up next for me is AbbVie, then Microsoft, J&J, DIVO, which is my first CC ETF, then JetQ followed by GPIQ, also CC ETFs, then Enterprise Products Partners and MLP, then BTI, Goldman Sachs, Duke Energy, McDonald's, and finishing off page 1 is Procter & Gamble. Moving on to page 2, we see that I have Coca-Cola, Pepsi, Southern Company, Philip Morris, ExxonMobil, Kimberly-Clark, Caterpillar, Apple, Chevron, Colgate Palmolive, Travelers Insurance, IDVO, my final CC ETF, then Home Depot and Starbucks. I have a little less than 15% of my portfolio in CC ETFs for those that are curious. In total, you can see my portfolio is at $3.53 million worth of tickers, and I generate about $151,000 a year. Of course, I could always move much heavier into 10% yielding CC ETFs to generate $350,000 a year of income, but that wouldn't align to my personal risk tolerances or overall goals. And again, just because I do something doesn't mean you should. Moving on, we come to my dividend calendar view, which is currently showing my last month's dividends, this month's dividends highlighted in green, and the next 5 months of divvies I should be getting. This is still sorted from my largest position down to my smallest. So MO is up top, and you can see how this month it's paying out $4,000, then should do so again in January of 2026. Realty income is in the next row, and you can see it pays me a little over $1,000 a month. You can also see that I got $1,020 last month from O, but $1,022 this month because they did one of their tiny dividend increases. They normally do 3 or so small increases a year, followed by one bigger hike. Looking at the bottom of the page, we can see my monthly dividend totals for each month, so last month I was paid a little over $14,000 in dividends. This month I'll get about $10,800, then $12,400 in November, $14,000 in December, $11,200 in January, $12,400 in Feb, and $14,300 in March. And then here's a chart of my dividend income received since I started this new spreadsheet about 6 years ago. You can see how my income has been trending up over time, though if we have a big market crash and we stay down, then I'd expect my income will drop, mostly from my CC ETFs that I anticipate will average lower payouts when their bases are materially lower. Moving on, we come to this part of my spreadsheet which shows how my dividend income is expected to grow over time. The top row is the no investment row, i.e. if I'm spending all my dividends and the payouts just go up from dividend hikes. The bottom row of estimates is if I was reinvesting all my divvies rather than spending them. And since I'm spending almost all of my divvies and just reinvesting a small amount of my ETFs, I'll probably end up somewhere between these two rows, being closer to the top row. I make about $151,000 a year right now in divvy income, then a year from now I should make about $158,000, then $167,000 the year after that, all the way out to year 10 where it estimates I'd be making $252,000 a year. Or if I'd been reinvesting my divvies rather than spending them, then at year 10 it estimates that I'd be making $365,000 a year. So definitely reinvest all your divvies if you can so you can really get your snowball growing. And then in the middle here it shows I make about 12,566 divvies a month, or about $2,900 a week, or about $413 a day, or about $17.21 an hour, every hour, 24 by 7 by 365. And then this chart shows estimated dividend income over the next 35 years, with the red line being how fast things could grow if I was reinvesting for multiple decades, versus the blue line which is how my income would grow if I was spending all my divvies. This really makes the case of how powerful it is to reinvest and compound your income growth. So hopefully you enjoyed my portfolio update, and if so, then I ask you to please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Moving on, now I'd like to show my gratitude to subscribers who left me kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to WW34, Novelitos, DZ Divs, Scott Bachmeyer, Jack Lanzalotti, Arnold Family, Kevin Mendoza, Playman Vasilev, and then multiple from Robert Clarkson, and then multiple from the Camerons Anderson or Sanderson. Thanks folks, I really appreciate it. And with that, I'll close things off and recommend you check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'd also like to pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.